While the world obsesses over missile tests and diplomatic theater, the real war has already begun. China is executing the most audacious resource grab in human history, a systematic stranglehold on the very atoms that make civilization possible. And by the time Western governments realize what's happened, the cage will be locked. The metals in your phone, the rare earths in electric motors, the lithium in batteries, the copper threading through civilization's nervous system. One nation is cornering the market on all of it. But here's what should terrify you. This isn't new. It's been happening for years. You just weren't looking. Beijing understood something 2 decades ago that Washington is only beginning to grasp. In the 21st century, power flows from whoever controls the building blocks of technology itself. Think of it as chess on a geologic timescale. While Western nations financialized everything, turning assets into derivatives, derivatives into securities, securities into abstract numbers, China moved in the opposite direction, converting paper into atoms, dollars into dirt, treasury bonds into tungsten. The pattern is everywhere once you train your eyes to see it. Chinese state-owned enterprises outbidding Western competitors for obscure mining rights in the Congo. Mysterious price spikes in metals most people have never heard of. Massive ships leaving Australian ports loaded with lithium or destination Guangzhou. Import figures that don't match manufacturing output. The numbers betray a different story than official narratives claim. This isn't capitalism. This is strategic resource warfare dressed in the language of commerce. Consider the scope of the operation. Rhodium for catalytic converters, China buying aggressively. Palladium for electronics, stockpiling at unprecedented levels. Rare earth elements like neodymium and dysprosium, critical for everything from wind turbines to precision-guided missiles. They already control 70 to 90% of global processing capacity. Not mining. Processing. Even when Australia digs it from the ground, it flows to China to be refined, because that's where the expertise was deliberately concentrated. Cobalt for battery stability. Nickel for steel alloys. Gallium for semiconductors. Germanium for fiber optics. Indium for touchscreens. The list reads like a periodic table shopping spree, backed by unlimited state financing. And here's the beautiful, terrifying elegance of the strategy. Every ton of copper purchased is a ton of dollars converted into something real, something that doesn't inflate away, something that holds intrinsic value, because industries cannot function without it. They're not just buying commodities, they're dumping a depreciating currency for the physical foundations of the next century. But what most experts still don't understand is how this connects to what's about to happen to your savings. To understand the end game, look at what's happening right now in the silver market. Because silver has become the perfect microcosm of this entire invisible war. Silver prices have detonated. We're talking about trading above $76 per ounce, a 150% gain in 12 months. That's not normal market behavior. That's what happens when supply meets a wall of relentless, desperate demand. Here's what changed. Silver evolved. It's no longer just a monetary metal for coins and jewelry. Governments now classify it as strategically critical. Why? Because modern technology is ravenous for it. Semiconductor manufacturing devours it. Solar panels at scale require vast quantities. Defense systems can't function without it. Medical devices depend on its unique properties. The electrical grid demands it. Too many buyers. Not enough metal. Economics 101 says prices must rise. But the real story is happening in China, and it reveals a psychology of resource panic spreading through an entire nation. Chinese investors, both institutional giants and everyday retail, traders have discovered a disturbing truth about paper-silver markets. For every physical ounce sitting in a vault, Teta might be 100 contracts claiming ownership. It's fractional reserve banking applied to precious metals, a system built on the assumption that not everyone will demand delivery simultaneously. Once you see that ratio 100 paper climbs to 1 real ounce, the rational response becomes brutally obvious. Buy physical. Take. Delivery. Never trust paper promises. And that's exactly what's erupting across China right now. Everyone wants the real metal, not contracts, not ETF shares. Actual bars they can hold. The numbers reveal genuine mania. The UBS Silver Fund in China has become so saturated with desperate money that investors are paying 60% premiums over net asset value. Read that again slowly. People are voluntarily paying $1.60 for every dollar of actual silver in the fund. Takeover, 60 cents for the privilege of accessing metal they can't even possess. That premium is insane. When it collapses, and it will, those investors will be massacred. But here's what the mania tells us. Physical silver supply in China is so catastrophically tight that people cannot acquire metal through normal channels at any price. The shortage is real, and investors are so terrified of being locked out entirely that they're paying whatever it takes today, hoping prices rise fast enough to justify even absurd premiums tomorrow. Silver is trading $10 per ounce higher in Shanghai than in London, a 10% arbitrage gap that persists because the normal mechanisms that should close it have broken down. Supply is that, constrained. Beneath the speculation, beneath the mania, is a fundamental truth. China sees silver as essential infrastructure for the future, and they're absorbing supply like a black hole. But here's the critical insight. Silver is just the opening act, because the exact same dynamic is playing out simultaneously across dozens of strategic materials you've never heard of. Imagine waking up tomorrow to discover that one country controls access to the materials needed for smartphones, for electric vehicles, for solar panels, for defense systems, for aerospace, for advanced medicine. You don't have to imagine, it's already happening. China isn't just stockpiling silver in isolation. They're executing a comprehensive campaign to secure dominant positions across nearly every critical material. Modern civilization depends on copper for electrical infrastructure, lithium for battery production, cobalt for energy density, nickel for metallurgy, rare earths for magnets, manganese for steel, chromium for corrosion resistance, tungsten for industrial tooling, molybdenum for high-strength alloys, vanadium for energy storage. The list stretches across the entire industrial spectrum, and state-owned enterprises, backed by unlimited funding and zero concern for quarterly earnings reports, are systematically locking down supply. It wouldn't be remotely surprising if Chinese strategic reserves contain billions of dollars worth of these materials. Billions of ounces across various metals, quantities that never appear in official statistics because transparency would reveal just how far ahead they've already moved. This is resource competition at a scale humanity has rarely witnessed during peacetime, and it's invisible because there are no explosions, no dramatic headlines. Just patient, methodical buying. Month after month, year after year. The implications are staggering. If you control raw materials, you control who gets to manufacture. If you control manufacturing, you control prices. If you control prices, you control economies. It's not complicated. It's brutally simple. And Beijing has been playing this game while Western nations were distracted by political theater and financial engineering. Here's the kicker that ties everything together. Every dollar China spends converting reserves into physical resources is one less dollar supporting U.S. Treasury markets. One less dollar providing demand for American currency. It's constant, relentless pressure in one direction. The reserve currency is being hollowed out by 1,000 transactions happening in commodity markets most people don't even know exist. But there's another force about to accelerate dollar weakness from a direction almost nobody is watching. Japan is about to become America's biggest currency problem. Not intentionally. Not simply because they have no choice. The Bank of Japan just raised interest rates, and they've signaled clearly. More hikes are coming. This matters enormously because Japan isn't some minor player. They're one of the largest holders of U.S. Treasury bonds on the planet. Over $1 trillion in American government debt sitting on their balance sheet. Here's the problem they're facing. Despite raising rates, the yen is still collapsing. It's falling against the dollar, against the euro, against nearly every major currency. This creates a vicious cycle of import inflation that's crushing Japanese consumers. The central bank has made it explicit. Saving the yen is now the absolute top priority. Everything else is secondary. But to keep hiking rates aggressively without destroying their own government finances, remember? Japan has debt approaching 250% of GDP. They need to generate cash, and the only realistic source is selling foreign assets. Translation: massive treasury sales are coming. Hundreds of billions of dollars in U.S. government bonds flooding the market as Japan defends its currency. That's enormous selling pressure on U.S. bond markets, which means upward pressure on yields, which means downward pressure on the dollar. It's mechanical, unavoidable. But wait, there's more. The yen carry trade is unwinding. For those unfamiliar, this has been one of the most profitable trades in global finance for over a decade. The mechanics are simple. Borrow yen at near zero interest rates, convert to dollars, buy higher yielding U.S. assets, pocket the difference. When leveraged properly, the returns are spectacular. This trade has funneled enormous amounts of capital into U.S. markets for years, artificially supporting asset prices and suppressing yields. But the math only works when Japanese rates stay low and the yen stays weak. As rates rise and the yen threatens to strengthen, the entire logic collapses. Worse, it becomes actively dangerous. If you borrowed yen and the yen suddenly appreciates, you now owe far more in dollar terms than you originally borrowed. Meanwhile, the U.S. assets you bought with that borrowed money might be declining in value. You're getting destroyed from both sides simultaneously. Every sophisticated trader understands the risk-reward is now catastrophic. The only rational move is to exit. And that's exactly what we're seeing. Systematic, methodical unwinding of one of the largest trades in global finance, which means capital flowing out of U.S. assets, selling pressure on bonds, reduced demand for dollars, all happening at the exact same time as China's resource buying spree. These aren't isolated events. They're synchronized hammers striking the same nail. Step back. See the complete picture. China converting hundreds of billions into physical resources. The dollar in a structural down cycle that lasts 5 years or more. Japan dumping treasuries while carry trades unwind. Global trade shifting away from dollar transactions. Strategic resources appreciating against fiat currencies. These aren't separate problems. They're interconnected failures in the post-war financial architecture. They don't add together. They multiply. They create feedback loops. Each factor amplifies the others. The United States will debase the dollar further to fund its own belated stockpiling. More dollar supply, both superpowers competing for finite resources, both strategies crushing dollar value from different angles. Wall Street analyzes each issue in isolation, but complex systems don't work that way. Everything affects everything else. The interactions are where civilizations either adapt or collapse. This isn't a normal market cycle. This is a generational shift in global power. The framework that dominated since 1945 is being challenged by patient strategic positioning. Options traders betting their own money are extremely bearish on the dollar, because structural down cycles typically last half a decade or longer. We're only in year one. What does this mean for anyone holding wealth in dollars? The assumptions that worked for 50 years might fail for the next 50. Real physical assets, tangible resources. Strategic materials are becoming more valuable relative to paper currencies. We're entering extended monetary instability where traditional safe havens won't perform as expected. Think carefully about diversification. Not just across stocks or bonds, but different asset classes entirely. Different currencies, different jurisdictions. The uncomfortable truth. We're watching the shift toward a multipolar currency system. The dollar will remain important, but its dominance, its ability to print without consequence, its automatic status for global reserves, that era is ending. Not overnight. Not overnight. Gradually, then suddenly, the way Hemingway described bankruptcy. China played the long game for decades, accumulating physical foundations of industrial power, while Western nations focused on financial engineering. Now, as supply chains fracture and resource competition intensifies, whoever owns the materials doesn't just participate in the future economy. They control it. The decisions being made now by governments, central banks, individual investors will echo for generations. Knowledge is your only defense during major transitions. Understanding what's happening beneath headlines. Seeing patterns before they become obvious. Because by the time everyone sees it, the opportunity to position yourself will be gone. The invisible siege is underway. The cage is being built one transaction at a time. Most people won't realize they're trapped until they try to move and discover the bars are locked. The question isn't whether this shift is happening. The evidence is overwhelming. The only question is, what are you going to do about it?